Oh my God, where am I? Who knows? But you know what? There's a lot of dispersion going on this video. So we're talking about dispersion today on the workshop and how it works. And I think we'll have some interesting little slides to go through some of this. So let's get right to it with the guys after the bell, which I don't have with me in Mexico. Clink.
We need like a mariachi band instead for you or something.
Yeah,
I don't know that Yellowstone goes with your vibe.
My God. So I'm going to be on tape delay because of the Mexican internet. You know, no offense, but it's not exactly great. What is great is this view, though. I got to tell you, it's pretty nice here. I've never been to a place, I don't think, that has consistently perfect weather every single day. I'm serious. I mean, I've been here for a week or so, and it's the same routine every day. It's 70 at night and 78 in the day, and I haven't seen a cloud since I've been here.
That's not what it's like in Chicago?
No, this is unbelievable. Chicago's like a dispersion trade, man. You get everything. So this is very consistent.
I was going to say, if only trading was that consistent and easy in blue sky.
Right. Unbelievable. Good to see you guys. So today's dispersion, Jason, I know you have something to share today, but let's just kind of lay it up. I'll let you guys do a little chatting about it. Your thoughts on it. Who wants to go first? Mark, you, Jason, you want to talk a little bit about just general definition? Let's start there, just so people understand what this means.
All right,
Mark, tee it up, Jason.
All right, I'll take it.
Okay.
So dispersion means basically that you are trading the overall, like an overall index, and then trading its components in different ratios, trying to hedge out the overall market risk to each individual stock risk. So, for instance, if you are trading, say, QQQ, and then you're trading the Mag 7, some long, some short, that's essentially what dispersion is. When you see like kind of stock picking or rotations, that's what you're seeing is dispersion realignment.
Okay, Mark, you want to add something to that, and I'll throw something in?
Yeah, I generally complement that with the idea that dispersion is kind of the relationship between what a basket of stocks are doing as a basket and what they're individually doing as components. And so, like in a volatility sense, that would be comparing the implied volatility of the SPX versus the implied volatility of 500 components or 100 components in the NASDAQ scenario. Mm-hmm. And so generally, the idea that an index is going to move less than the components because there are going to be offsets, right? On some days, Apple goes up and Microsoft goes down. And so the Qs on whole are flat, even though there's individual volatility in their components. So when we talk about measuring dispersion, something like the DSPX index that the SIBO has, that is the kind of differential between the individual component movements versus the overall netting effect of, their offsetting moves.
Right. Okay, good. Now, do you guys think, so Mark, back to our floor trading days and with the firms, do you think a lot of the market making firms are using dispersion with their books? Are they typically pounding out premium in the indices and probably long gamma and, kind of the curve in individual components? Is that how it generally sets up to this day, or has it changed a bit?
Yeah, I mean, I'll start out by maybe like defining a little bit about what that trade would be. So like if you want to capture that dispersion or be long or short dispersion, generally the, kind of the standard way it gets put on is you want to be long the components because you expect them to move more and short the index vol. You can obviously go long or short either leg of that. But generally the idea is to sell index vol to buy components because you expect them to move a little bit more.
Mhm.
As for the players in it, I think to some degree, like a market maker managing their book is thinking about how components might vary together. But I actually think some of the biggest players in this space are more like some of the pod shops and whatnot, that, a market maker is generally more concerned about inventory management. And while they might be, thinking about where they want to be long gamma in their book and where they want to be short gamma in their book, explicitly putting on this index versus component trade is much more like the Citadel like hedge fund side of things, as opposed to the Citadel Securities side of things, the Millennium world, like the pod shop, non-dealer, large institutional players in the market.
Okay, got it. Yeah, I mean, and so maybe Jason, you can answer this. How can a retail trader use this mechanism? So let me just qualify it too. How mathematical does he or she need to be precise? And is it like dropping grenades? That's my favorite little saying in trading options. Just get close, or do you have to really hone in the numbers? If SPX is at a 17 vol and you have all your components that match up to 17 vol, do you have to be perfect, or you kind of just thumbnail it and be fuzzy? What thoughts? And and Mark, jump in after Jason too if you think about.
Yeah, I think it depends on what you're trying to do. If you're trying to, if you're like Mark said, a lot of like big hedge funds do all the components versus the index, and because the components typically, I mean, almost always have a higher vol than the index because they all have idiosyncratic risk associated with them. So when you combine all their vol and then you get the index vol, it's usually the components that have the higher vol. If what you're trying to do is isolate a company, like if you're a retail person, I don't think you're going to have equal shares of 500 components and then SPX, or even 100 and the NASDAQ. I think if you are a retail person, you want to kind of beta weight yourself, have like a standard. If you're doing, say, NASDAQ, like QQQ with the MAG 7, and you're very good at determining, the direction of the MAG 7 as it relates to each other, but not as it relates to the overall market, you may want to have some kind of position in QQQ, either long or short, that tries to take out that that risk of the overall market interfering with your personal knowledge of the MAG 7. So how mathematical you are too depends on how sophisticated I think you are, because you want to beta weight to a standard, and then from that standard you want to go in and out of QQQ, as it relates to your total position in the MAG 7.
Right.
And again, I'm trying to do this from a retail standpoint. If you're doing options on, I mean, it's a lot more complicated mathematically. Probably, I don't know how much retail would be doing the basket of stocks, short vol the basket and long vol the index or something.
But yeah, I mean, I think I don't know how I feel about this one relative to retail. So I'm wondering, a lot of the big tech stocks comprise a big part of these indices, right? The ones that you guys just mentioned, the MAG 7s, they have a massive weighting in these big indices, right? And I guess I was getting at, can you sell SPX premium every, it's 0 DT now, right? Every day. So can you sell it, 1 DT, have 21-day long gamma in components? They have to be all the components. And if you get an outsized move in any one of those components in your portfolio, right, they're going to do great on the long gamma side, and SPX may be unchanged still, right? So you're actually harvesting, theta, and I don't have a bell, which I would hit right now, during that whole process. So I've tried it a little bit, to honestly. I find that, the harvesting part is the easy part. The hard part is the long side of the equation. Because if I have to make a trading decision on that, am I going to manage my gamma and deltas? I should say my deltas from gamma on that long trade, or am I taking the trade off because it's profitable? So now then I get, less covered by taking off my components. Does that make any sense? So it almost feels like I have to manage my deltas from gamma, right? If I'm going to keep that short position on or continually roll it. Any logic there or thoughts?
Yeah, I generally agree that, like, with both of you, that this is not your standard retail trade, right? To properly put on a true dispersion where you're either long or short index or long or short the components, like, we're talking tens of millions of dollars that you need to actually do this trade properly. And not only you need to do that, you need to properly be hedging stuff, Vega weighting, you can either Vega or theta weight it. Like, it's really freaking complicated. And like, you'd be better off like trying to get your way into Millennium and let them do it for you. So like, I think what's interesting about this, and this, obviously I'm going to speak a little bit from a market maker perspective, is thinking about the concept of dispersion and using that as kind of, a point of light as you're thinking about balancing your book, right? And thinking about where you want to be short and where you want to be long. And, I generally like the idea, Lex, to your point, that like being short a little bit of index premium because you expect it to move a little bit less, and being long the idiosyncratic risk. Like, as a general rule of thumb, like, I think that's a good way to construct a book. And even generalizing that more, be short some stuff that you don't think is going to move and be long the stuff that you think is going to be more likely to move. And obviously that's a little bit easier said than done, but dispersion is a concept of balancing where you think vol is going to offset or concentrate versus where vol is likely to have, bigger moves, is a good, overall options portfolio, active trader construction philosophy.
Yeah. So those are great points. I think, from my perspective, when I do these things, I've got, decades of experience from the old days, kind of understanding it a little bit, but I would say I'm not putting these trades on in a mathematical sense. I'd say I've got a good intuitive feel for when volatility is high and low, especially when it's an SPX type product versus the components, right? And our system shows that anyhow. And Jason, yours does too. And Mark, I'm sure you have something that works just as well. I can see that, but I can't make it granular so that I know exactly the mathematics that match up. No, I don't think I need to do that personally, and nor am I gonna, like you said, I'm not committing $10 million to my dispersion trade, right? But what I do notice is that in lower volatility environment, applied volatility environments, I still think I can sell index premium and buy components, right? Because that's where I want to buy them, is in the components, and I want to give myself time for that long gamma strategy to work. So I will push that out in time. I'm not pushing it out 90 days or 100 days. I'm pushing it out 30 days, right thereabouts. And I'm selling nearer dated premium, even though it might be lower in and of itself. But compared to my basket of stocks, I'm probably getting a pretty good value selling that premium and having a little protection. Is it perfect? No. But does it work pretty well? Yeah, it actually does. So,
And kind of an important element of all that, right, is like, if you're putting on the big complicated book of 500 straddles versus, the SPX straddles, like, you're delta hedging this and all that. But like, if you're doing it independently, you've got to recognize that you could lose on both trades, right? That like, you could be long Apple, long NVIDIA, long Microsoft, and short the Qs and lose on both, or all four, I should say, right?
Yeah,
like,
that's right.
That is an inherent risk of any pairs trade, right? Like, both or all of the legs here could go wrong.
Yep. 100%.
Yeah.
Go ahead, Jason. Sorry.
In the retail world, like, it's, I've never done a dispersion trade with options, like with the intent of trading those options. I think doing it with equities for a retail trader is the easiest and easier. Let's say. I do hedge with the options even within the dispersion trade, but being short Qs and long a bunch of the Mag 7s after they've sold off or something, that's a decent trade that I, in just the regular stock, you don't need to do the vol kind of stuff. You have to get realized vol for each of the components, and then SPX. It's very mathematically involved, and I don't think there's many retail traders that have the data or sophistication to do that.
Sure. Let me ask a side question relative to this. It's a little different. It's not necessarily dispersion, but for a retail person, again, a retail trader, do you think when the retail trader is long gamma and a move occurs, right? So there's going to be outsized deltas put into that position. Okay. Let's just say, we'll just make the example simple. You're long at the straddle, stock goes up pretty good. You get an outsized move. You're long a lot of deltas. Okay. And you have enough money in your account to play this game. What would you recommend to the retail person there? Do you sell the deltas out? Do you sell stock against those deltas, get delta neutral again like a market maker would? Or do you take the position off and rinse and repeat? I've always struggled with this with retail folks. I mean, because in our trading days, Mark, we had massive positions all over the place, and I'm just managing my deltas all the time. And when my position in volatility revalues itself and goes higher, and my Vega works, that's when I'm taking off. I'm selling calls instead of selling stock in that environment, right? To get out of it, because I'm reducing my position. Do you understand what I'm asking? So do you think a retail person can play that game like a market maker and sell stock, or should he or she just say, "I made money on this. That was my goal. Get out. Let's start over." Thoughts? Either of you?
I'd say get out. Usually,
okay, fair.
That's just
fair.
me.
I don't think I have a right answer. To be honest, I don't know what the answer is. And I know what I think as a retail person now, I think I'm getting out too. I don't know. I might be wrong though.
Yeah.
Mark, what do you think?
Complexity kills. I think that like once you start adding like multiple different legs in there and whatnot, like even if it is like a pure just, share sale against options and the underlying and whatnot, like same underlying, it's just more complexity, right? Like you're getting short. Maybe you have to worry about a borrow rate now, or like, close the position, find your edge in that options and move on. Like that, you don't have the capital and balance sheet and precision of pricing to be, making that, kind of complex offset.
Yeah. Okay. That's fair. Yeah. And the only thing I'd add to that is, when I do my crazy double diagonals and double calendars on earnings, there is one play that works well with that, is that if you can sell out of the good side of that trade, okay, and profit on all four legs by selling only two of the legs out, it costs you virtually nothing to keep the other two, right? Because you can, and I've shown where I've hit a double, where I've hit the top side and market turns around, and now I hit the downside and I double my profit there. So I like that kind of play. If you can set something up like that. Additionally, in those calendars, when you have the short side expiring first, what can happen also is if you have time on the long side, and you've already paid for the whole trade, you have a free call or put depending on which side you take off. So you can have just a naked put sitting out there or a naked call sitting out there, right? And you know what? If I have one position now where I've got 20 days to go, I've paid for the whole position. I've got a call. I can't remember if it's call or put, but on for credit, whatever I got out of the thing. I did the whole four legs for, let's say 35 cents. I sold the call side for $1.25. I own it. So I kept the put on. The short put expired. I got one long put left. And you know what? It's probably going to expire worthless, but what happens if it doesn't? I got a free lotto ticket. It's free. So that's the only time I'd say for a retail person, think about those sort of things when that opportunity presents itself, because sometimes it does. And, you don't have to get out of all four legs on those. Might as well keep it.
Mm-hmm. Yeah, no, I agree. I like that. I always like those strategies, especially like, one of my favorite strategies is like having a butterfly. And then if the price goes against you for a little bit, selling the profitable wing of the butterfly, if your thesis is still holding, to try to get that, to try to juice your gains when the market reverses. Yep.
Okay. What else on dispersion? Anything else we should think about here? I think we've decided that it's probably not the greatest tact for a retail person to employ. Assuming, I guess, you're not trading a gigantic book and you have a pretty good system mathematically of figuring this stuff out. Thumbnailing it probably isn't a great idea either, even though yours truly does it a little bit from time to time. So I don't have an idea. There's a bird above me. I don't have an idea of my track record on my thumbnails yet. I know the short premium in the index works great though. That part works. So
yeah, I mean, from like right now, actually, we have a trade in healthcare that's a little bit of a dispersion.
Okay.
And that's mainly on Voland. We have a widget called Volhacks, which kind of tries to simplify like our data into high or low volatility and high or low or bullish or bearish kind of leaning. And in healthcare right now, XLV, all the pharmaceuticals are on the bearish side and all the medical devices are on the bullish side. So we kind of like, did that spread with a bullish XLV trade. And that's basically kind of how we do our dispersion.
Okay. Do you want to share something, Jason?
Yeah, sure. You can. Hold on. Let me
and explain your screen here. I know we talked about it pre-show, but I forgot to bring that up. Sorry. Okay. Oh my God, it's 2 quadrants.
Well, actually, I have a lot of these quad screeners, and the reason why
all kinds of quadrants. What the hell are we looking at?
I have one for every sector that I care about, right?
Okay. All right. What are these?
Here is banking. Over here is our is the healthcare one that I was talking about, and you see like J&J, Merck, AbbVie, Guild. They're all kind of more on the bearish side.
Okay. Is that the left side of the graph here, or the left side?
Yeah, the left side is kind of bearish. So here you have direction, and they're all stochastic. So you kind of have to. This is just to give you ideas on what to do, not to, determine everything. But, and then UNH, there's also insurers in XLV that are over here on the left side. But then you come over here, these are 3 medical devices, the Abbott Technologies. If you ever got an MRI, you sit there staring at the Abbott Technologies sticker above your head for a solid hour. That kind of stuff is very positive. So we have like long medical devices, short pharmaceuticals, and then we're also long XLV to try to get the market risk out. And
so is this part of the hedge fund things that you do?
Yeah,
Okay.
Yeah, it's part of our Tyrios package. Yeah.
Okay.
But it also keeps you like if the whole market is going down, well, part of your portfolio is coming down. But the other part's going up, so it kind of takes out a little bit of that market risk.
And do you use this for stock against stock, or are you using option strategies?
We don't do the only option strategy we have attached to this is to hedge try to get out idiosyncratic risk on each position. But this is just stock to stock. That's all. And we beta weight it to its ETF. So in this case, we beta weight it to XLV. So like the ones that are normally very volatile, more volatile than the index, we have less stock of that and more of the ones that are less volatile compared to the index.
Got it. Okay, cool.
It's not an exact science. It's obviously, but it also helps prevent your hedge from becoming your primary trade, right? That's like the big problem with hedging is when does the hedge become your primary trade?
Right. Okay.
So that's kind of, and then we have the same here. SPX and SPY are very bullish, but a lot of these components are bearish. So, we've had this kind of dispersion kind of trade on for a little while, and it's been working out, even though like NVIDIA, I guess NVIDIA is down today, but, some of these went down more than others, but now we see Meta and Microsoft who've been hit pretty hard. We see them kind of creeping up toward the bullish side. So we, start taking off shorts of these two and maybe making them a little longer so that we have better dispersion. So that's kind of an application of how we use dispersion, but I don't use it on the option side just because I don't have the setup to be as mathematically precise as say a market maker or a hedge fund, big hedge fund yet.
Got it. Okay, cool. I love it. And Mark, you're not doing a ton of this, right? With your books?
No, not necessarily. I think I would say my 2 kind of takeaways from dispersion and how, anyone but like the, real big billion-dollar funds should think about this is kind of the point that we talked about in terms of like overall book construction. Generally, where do you want to be long? Where do you want to be short? What's going on? Understanding like the backdrop of this is like a trade in the market. I think it's always interesting no matter who you are as a participant. And then the second element, and I sort of called this out a little bit before, but like the SIBO now tracks the DSPX index, which is the dispersion differential between, or the differential between index vol and component vol.
Okay.
And tracking that as a kind of market indicator, I think is generally interesting because as that dispersion number compresses, that's essentially saying that, components are going to all start to behave much more similarly. Whereas as that number expands, whether that's around earnings season or whether that's around, individual idiosyncratic risks for each, component, knowing what the market's generally pricing, like, do we expect to see individual stocks, varying quite a bit more than the index, or do we expect them to be a lot more similar? Like that market expectation of those, divergences, I think is an interesting point of light as you're, evaluating the macro environment.
Yeah, that's interesting. So that dispersion, what is it? What's the ticker again?
DSPX.
DSPX, and it's a single number. Is that correct?
Correct.
Okay. And so a higher number is more dispersion, lower number contraction.
Yep, I believe it's floored at 100, which would mean that the components are expecting to be exactly the same as the index, and the higher that goes, the more you're expecting Apple to zig while Nvidia zags.
Okay. Got it. Well, that's a nice little indicator, and you actually it's just a cash price, and you actually can't trade it, right? It's just an indicator right now.
I believe they have futures on it, but they have not listed options on it yet.
Okay,
there are plans, but I think liquidity is still relatively low.
Gotcha.
And to be clear, that's a predictive measure, right? We're looking at implied volatility in both of these. It's not a realized. This is an implied number.
Yeah, got it. Okay, well maybe we'll get one of the SIBO guys. I know Ed Toms does that, and Mandy Zoo, I believe, does a lot of that stuff too. We'll get them on the show one of these days to explain that. That'd be kind of cool.
I'll have to do a little homework before that happens.
Yeah, no, me too, for sure. My God. All right, good deal, guys. Great chat. Good to see you guys. Mark, I feel horrible that you're in all that snow. I'm in a t-shirt and shorts for another day, and then I'm going to go back in the snow.
Because me and Lex, you and I have like the same shirt.
I know.
I was going to go change my shirt, but then I was like, oh, Lex got the same shirt. I think I'm all right.
I know. It's just relaxing today. All right. What else? Jason, go ahead. Plug me.
Vol.land for dashboard for dealer positioning.
Yep. Awesome. Mark?
And harvestedfinancial.com for checking out everything I'm writing in the till and what you get from the tape report.
Awesome. And then always send me an email, lex@tradier.com. Don't forget to sign up for a hub.tradier.com. We are planning our live summit coming to you in early May. We hope you can make it, but you won't know anything about it if you don't sign up and subscribe to the hub. It is free. So make sure you do that. We will have fun. These gents, I hope, are going to be at the summit in Palm Beach, Florida in early May. More details to follow. We're almost done with the planning stages, so stay tuned. What else? We'll be back next week, I think. Same time.
Yep.
Thursday, 9:00 Central Time, Traders Workshop. Good to see you guys. Have a great rest of the week. And Mark, what else?
Happy trading.
Happy trading, everyone. I don't know.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.